Here are 6 companies that we think have pretty solid dividend paying capabilities. Disclaimer: of the 6 companies, we do own 2. That is Uchitech and Harrison. As another disclaimer, none of what we say should be taken as financial advice. We are not professionals. Please speak to one. Hey guys, if you're interested in building a 6 to 7 figure portfolio using the power of stock investing, head over to the comment section or the description to sign up for our free masterclass so that we share with you exactly how we do it. So I'd like to start with a quote from a pretty legendary investor in Malaysia, but you probably not heard of him. However, he wrote a book in 1985 called Stock Investment in Malaysia and Singapore. Something like that. Very plain name. But he wrote something, a poem essentially, that I think is very important for all of us to know. And that is: a cow for its milk, bees for their honey, shares, by golly, for their dividends. So a dividend plays a very big role in everybody's portfolio. And in fact, very often when we analyze a company, we will think of things like, hey, what's the PE of the company, right? And the way we think about it is, let's say if it's 10 times PE, means it takes 10 years for me to get back their money. However, as a minority shareholder, is that really the case? Do you actually get the earnings? Sometimes no, actually, because they do not pay out those earnings. So while it's true, you get to see in the reports that they earn 1 million, 2 million, 10 million, but the money never really reaches you. And sometimes management just kind of keeps it to themselves, don't really do much to it. The only time you can get it is when they pay some form of dividend, some sort of payout. Of course, the most famous type of payout is called dividend. There are other types, but dividend is number one.
Yes.
So that's why we like to do start this video with this poem to remind you why dividends are very important. So what are the criteria that we use to find these 6 companies? The first is a dividend yield of at least 5% of current dividend yield.
Yes, correct.
So current dividend yield,
which is higher a little bit than the risk-free rate, which is the fixed deposit.
Yes.
More or less the same as EPF's rate. 5% to 5 to 6%.
Yeah, slightly under, right?
Yeah.
Number 2, they need to be consistent or increasing their payout over the past 10 years. So this is a very important point because many people who are dividend investing kind of just stop at dividend yield and they just look at it and they compare it to their FD or their EPF and say, oh, very good, right?
Yeah.
It's higher, so I buy. That's not how it works, because dividends don't just appear out of nowhere. They don't just appear on your screen. They don't just appear on an announcement, okay? Dividend, for it to be in your hands, a lot of things have to happen, right?
Yeah.
A business have to exist, things have to be run well, management has to be good and honest, management's incentive needs to be aligned, and then the industry that the company is in needs to be pretty good. Otherwise, you cannot increase or even just maintain the dividend. So that's very important for us. And of course, another important criteria is that we actually exclude special dividends. Some of these companies that you see here actually have special dividends. What's a special dividend? Well, what's a special dividend, right? It's out of the ordinary. If a company pays dividends once every 2 years, suddenly that year they decide to pay for a third time, that's usually a special dividend. Or maybe they've sold off some assets, or they've got a huge amount of profits and they feel that, okay, now our cash balance has increased, so let me pay out some of the dividends.
Exactly.
So the first company is MBMR. Of course, if you've been following the news over the past month, UMW is in the process of being acquired by Sime Darby.
Yes.
Car trading, distributing company. And MBMR is one of them. Most famously, Perodua, right? So the share price have rallied pretty decent when you compare to around here. Year to date, I'm not sure what it is, but it's definitely quite a bit higher. This is the dividends paid versus the profit. So you can see it's pretty consistent. And as of around 2018, it has been rising. So one interesting sign is that in 2017, profits actually drop, and yet they didn't maintain the dividend. They dropped it a little bit, but they still can pay out. So that's quite a rare occurrence. So you can see here the dividend yield has gone up quite a bit, and maybe we'll start the dividend yield, right, Jonathan? Why is it gone up so much since 2018?
Yeah, actually, if you compare, before I even start to explain, you need to know what is the formula of dividend yield. So it's basically your dividend amount that's paid out to you divided by the market cap or share price of that particular company. So dividend yield can go up in two ways. One is that the dividend payout is increasing. Two, share price is reducing, or three, both occurring at the same time. Then you can get an extraordinary kind of like growth, which is why you see that here there's a 11% yield for MBMR, because the payout actually increased faster than the share price actually increased. Or actually the share price didn't even budge. It's like pretty much stagnant around this price range. But then if you look at the dividend payout, right, it has steadily going up as time goes by. And yeah, a lot of the profit actually comes from Perodua, because they got like a 25% stake or 20% stake in Perodua, which is why they also can get some profit when Perodua ever makes money. And if you look at their payout, right, it has actually been quite, I would say pretty generous, about 50% dividend payout as compared to the profits. Yeah. And so far, the past 3 years, they have been maintaining around that area. So so far is pretty good dividend paying.
So what is the important trend here is that the profits are up, but the payout is higher, which means that at least compared to 10 years ago, the dividend has grown faster than the profits itself. And so that's, I think, a good thing, because MBMR is a protected company, right, through Perodua. And some of the issues with protected companies as a Malaysia, I'm sure you know, is that they tend to underperform. They're pretty bad, right? They're not profitable, even though they're the only guy doing it. I won't name names, but you know who they are. And MBMR is one of two, them and Proton, right? They are being protected in Malaysia. And yet you can see a pretty good performance. So kudos to the team. So
yeah, and you can see that this is the net cash. So net cash is basically when they're in the negative, then it's net cash. When if the positive means they're in a net debt position. So in I think 2018, right, 2017, there was actually a payout from despite making a loss making in 2017. So not sure how did they use their money to pay out. Probably is from their cash flow, because profit you can be on paper say that you're making loss, but in cash flow wise you're coming in money. But that one you have to double check and see the cash flow statement itself. But other than that, there's another alternative, which is actually use debt to pay out dividend, which is actually not really quite a good sign if you are using debt just to please your shareholders. I mean, yeah, it's very bad. But then if you look at after that, after 2017, right, things have changed. I mean, they are making more money in cash in return in the past 2019 to even 2022. And you can see that now cash is actually almost like 40% of the market cap, if I'm not mistaken. Yeah, which is a pretty huge turnaround for MBMR. And right now, the price also has been pretty stagnant. Profits, dividends are all increasing. So yeah, that's why it's on the number one spot in our dividend paying stocks. And yeah, if you actually invested in MBMR, sadly, in 2013, your 1K investment will turn out to be 1.069 in 2022. And the reason is also because back then in 2013, if assuming you buy at quite the peak, the share price actually kind of fallen about 23%. So that's the reason why, even though the dividend increased, but it didn't really help to cover the share depreciation. Yeah,
sadly. But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description. Okay, second company, Uchitech. This is probably the king of dividends in Malaysia. They consistently have dividend yields that are above your EPF.
Yeah.
And the share price rise as well. I think I did like a back of the envelope calculation. If you bought this company since the beginning, you're looking at a 16% compounded return every year. And it only moves one way. I still remember looking at the company around here And I thought, wow, so slow. Wow, it jumped up and then it went down a bit. And I thought, okay, that's it. It's gone. But it's back up again. So that's Uchitech. Their dividends tend to track their profits.
Yes.
Honest management. Taiwanese management. The culture in Taiwan tends to be that they pay out a lot of their earnings because they know what Neo Soon Ken says and they want a more vibrant market. So here you get the payout. Pretty good. I believe in 2018 it's a little bit higher because they had a capital repayment, something like a special dividend. It's pretty good. Now you can see the dividend yield has been pretty, it's very similar to EPF.
Yeah.
Very, very similar, right? Net cash, they actually have less or more cash, right?
Yeah.
Right.
So
okay. Right.
Correct. So when it's negative, there's net cash.
So this company will always be net cash because their business model is very high margin, and they have exclusivity with a single partner, which is Yura, which contributes, I believe, 90% of their revenues. So that's why they are a cash gushing machine. So this is the share price, around 9.63%, 10 years. So you add the dividends, it comes to closer to the number I gave just now, right? This year is about 14%, 14.5%. When I calculated, it was about 16. And in fact, if you took all the dividends that they paid and reinvested, you could even get 18% every year, which is phenomenal.
Yes, this is.
So then you have here 2022 to 2023. Share price increase 150%. That's very dividend. That's better than the S&P 500 if you exclude currency conversion, of course.
Yes.
And dividends have risen by quite a bit as well. Your 1,000 ringgit will become nearly 3.6k.
Yes, very good.
Okay, next one, Gas Malaysia, another company that is almost impossible to go out of business.
Yep.
Because everybody needs gas. And it's Gas Malaysia. Whenever there's a Malaysia there, I don't know how you can go bankrupt or lose money.
Yeah.
You can see it tracks pretty much the dividends and profits. Same story. Dividend payout is dropping a little bit while the dividend yield is rising. I suspect the dividend yield is rising. Oh, okay. Actually, it's rising with the share price. So that's very interesting. And even with a dropping payout, does this mean that their profits are actually increasing really fast?
Yes. It's actually trending even faster than the dividend that they pay out.
Yeah.
So that's a very good sign for Gas Malaysia. And they've been doing that for the past 10, actually even further, not even 10 years, actually it's more than that. And they're also in a net cash position, which is pretty interesting because I initially thought that they're going to have more debt, but then surprisingly, they are keeping more cash at the moment. And so the sad thing is that because if you look at the share price history, right, it has been very flat. Like nothing much. And if you buy in 2013 at the peak, right, this is where I recorded. And if you compare to 2022, right, you are actually down quite a lot. So you can see that even though your dividend have grew like 37%, your share price is down 7%, but then you can see that if you, let's say, you invested in that peak and you still hold it until at the low side, you're only making about 342 ringgit in profits only. So that's it for Gas Malaysia. Okay,
FPI, another dividend monster, I would say, in Malaysia. They are into audio equipment, right?
Yes, and this is KC Chong's favorite. Yes. If you read his book, he mentioned this a lot.
So this one, profits rising faster than the dividends, but dividends not really slacking too much as well. Payout drop on average. A lot lumpier. Maybe it's an indication of how the business is like. But you can see the average dividend yield is actually higher than Uchitech, right? If you draw a line across here,
more or less,
right? It's
actually about the same,
5 to 6%. Cash is just piling up like crazy, so this is fantastic. And probably this is the highest returning stock right here.
Correct.
Right, it's a 6x. Share price is 16%. Dividend is CAGR of 13%. So this is like maybe even higher than Warren Buffett, actually. Berkshire Hathaway.
Yeah, imagine if you go all in FPI.
Yeah, crazy. So anything you want to add? Actually, I just have one question. Why is the payout so lumpy?
That's actually a good question. I'm not sure because I think this management have the and it's not like if I'm not mistaken, they don't really have a dividend policy. It's just that they have been paying out consistently.
Yeah.
So when I think it's to kind of reward the shareholders for holding FPI, and they have been like a dividend paying stocks for quite some time already. So even though despite they are not making as much of a profit, you can see that even though profit drops, right, they still want to pay out more dividends. Yeah, for the shareholders, and they can do that because they have a lot of cash.
Yes.
Yeah. So yeah, that's the totally different opposite lah. Like when you're committed to paying dividends and you have cash, right? Yeah, you can do wonders.
Alright guys, enjoying the video so far? If the answer is yes, remember, like, comment, subscribe. And as far as comments go, if you don't like the video, do let us know as well. We always take all sorts of feedback, as long as they're constructive. There you go. Hongra Industries, okay, what do they do?
Okay, so this one is that, you know, your motors or scooters, right? So they actually manufacture and also they kind of market and assemble all of these motorcycles and all this good stuff, and they sell it to Malaysians. And I think another business segment is more like property development, if I'm not mistaken.
So the share price is pretty flat.
Yes.
Doesn't really move. But dividend yield looks very interesting.
Yeah.
So dividend is very consistent. Profit is not very consistent. Very choppy. Maybe because of the development.
Yeah.
Probably contributes a little bit. Payout has been generally trending up. Dividend yield is also trending up. Okay, again, very close to FPI, Uchitech kind of level. Interesting. So cash piled up quite a bit. So that's always good. And your $1,000 investment will become 2,000, nearly 2,008. Only issue is the share price hasn't really moved.
Yeah.
Why do you think it hasn't moved?
I think also is because while you are looking at your Malaysian population only, you are trying to like sell all the motors and scooters in Malaysia, fixated in just one country, 33 million population. So I think although the growth is still there, I mean, it will slowly go up, but then how many people can actually own a lot of motorcycles? And one or two is enough already. Yeah. You can go to the extreme of 3 to 4 lah, but then who actually use it, right? That's Hong Leong industry.
So the last one, Harrison, this is based in East Malaysia.
Yes.
If you heard the company DKSH, here it's very somewhat similar to them. They are a distribution company, Harrison. And Harrison is actually distributing a lot of food products.
Yes.
So one of the reasons why we actually own the shares also because they have certain inflation-proof kind of business.
They have been, even though there's recession and everything, their profits has actually maintained and revenue growth has actually maintained.
Because they can pass on the cost probably to people, right?
Yeah.
So yeah, that's Harrison. They are mainly in East Malaysia. Profits have increased drastically since COVID.
Yep. And and dividend payout has been pretty stagnant. Yes. So they can actually pay out more, but then they have been very conservative.
Hopefully they can close the gap, right?
Yeah. So you can see that the payout ratio actually dropped from 70% to 30%, but yield has been very consistent at around 5%, which is about your EPF level. So that's pretty decent if you're actually investor of Harrison. And one cool fact about Harrison is that they are actually using a lot of debts to either finance their working capital or actually pay out dividends. And a lot of the debts are actually coming from short-term borrowing. And they can do that is because their business is very stable. And banks actually like to give them money because, well, as long as you need food and you need someone to help distribute from the maker to the retailer, right? That's where Harrison comes into the.
And another thing why they need that is also because of the way their business is, right? They require working capital.
Yes.
Because they buy a lot of inventories and things like that to eventually sell out to someone. So, in those cases, borrowing money in the short term is quite okay because you know for a fact that you're going to sell these products. I mean, it's food products, right?
Yeah.
So banks will be quite okay to just...
Yeah. I mean, less than 3 months, you already can convert your inventory to cash.
And fun fact, Harrison is like a 100-year-old company.
Yeah.
Right? more than 100, I believe.
Yes, more than 100. And they have like a 80 years contract with Nestle and also what's the beer company? It's not Carlsberg, it's not Heineken. Cannot remember what's the
Asahi.
Cannot remember what's the name. But then it's okay. It just went out of my mind.
Not,
it's a beer company.
not Heineken and not Carlsberg.
Oh, wait, sorry. I think it's Heineken. Should be Heineken. Yeah, 80
it
years.
cannot be not either of these. It's just both of them.
Yeah.
80 years, that's crazy. You know what? That is a contract that is longer than Malaysia and Singapore's water agreement.
Yeah.
So just so you know, right?
Exactly.
So 1,000 became 2,000 over 10 years, 2003, sorry. Share price hasn't
moved a lot. Yeah, it has been very slow moving.
But yeah, hopefully we think that the dividends closing the gap with the profits will mean that the share price will also be reflected. Okay. Yeah, just really the comments. I think one is, just because the company has high dividend doesn't mean it's a high return. You want consistent payouts. And this is the thing that people don't know, right? Even though a company can just pay you 3% every year, but if the reason that is 3% every year is that the share price keep going up, you're in fact actually receiving higher dividends every year.
Yep.
In other words, if you simulate again that the same company don't grow in share price, the dividend yield will actually go from 3, 3.5, 4, 4.5, 6, 7, 8, right? That's really what you want. I still remember when I first bought Nestle. I have a friend actually that bought Nestle when it was 2% dividend yield. So she kept holding the shares. And then I look back at the original price versus the newest dividend being paid. It's close to like 20%.
Wow.
So imagine like a property paying you like 20% every year. It's quite crazy. I think the ultimate formula and combination you want is if the dividend is growing as a result of profits growing as well. So you need to have been in the right industry, the right business model, and then of course you need the right management that is honest enough to pay out a lot of the dividends. And I would add a third one, if there was one, is that if the company does not have too much reinvestment opportunities. So what happens with a lot of company is that they can be very profitable, but then they start to be itchy hands. They start to diversify. Now, some companies out there are very good at doing that, but most people will fail their diversification. It's an unfortunate fact, especially if they start going to property developments and stuff like that. So you need the right management to be aware of the limitations of the company. And if you got this kind of management, they will actually stop the reinvestment into the company and actually pay out as dividends. And of course, IPI and Uchitech is a classic example. Uchitech is into these control systems for
your
coffee making machines. The market is not hyper growth.
Yep.
So why invest so much, right?
Yeah.
Keep the profits, pay it out. Number 3, special case.
Yeah, so this one is more on that even though there's growing dividend and profit in Gas Malaysia and MBMBAR, right? The share price actually didn't really grow a lot. So yeah, that's actually a special case. Wonder why is that happening? Yes,
so maybe something for you to investigate. And then the last one, past performance is not future. Very boring phrase, but it's very true. Take, for example, just to give you an idea, right? FPI's performance and their dividends is probably about better than Harrison.
Yeah.
But
right now,
FPI is in audio equipments. What's the future of audio equipments? I don't know, right? Whether new technology comes about makes them obsolete.
Yeah.
Question mark. However, with Harrison's, even though they've not performed as well, it's food.
Yeah.
Right. You would imagine 80 years from now, they will still be distributing food.
Yeah, and this is also justified from FPI's recent earnings. So you can see that earnings actually dropped quite a lot.
Yeah.
But then Harrison has been like quite steady, even though they have been slow, but have been very steady.
Yeah. So dividend investing is not as simple and straightforward as people think. People think that, there's growth, value, and dividend investing. Dividend investing is the simplest one, and then someone pay you nice dividends every other month. But they're all equally, I would say, as complicated.
Yes.
And in fact, you shouldn't define yourself as a specific kind of investor. So if you're interested in, getting your hand on some of the reports that we write that really help you, fast track your research journey into almost any companies, then you need to check out our FIRL Pro program. These reports, take you no more than 15 minutes to finish them. We produce them at least 2, sometimes even 3 or 4 a month. And so it's just, again, you can even ask us to research certain companies, make your life easy. That's really what this program is about. And if you want to check out what it looks like, we have a free sample in the comments and description. Go check it out and download. But whether or not you sign up, always thankful for the support. And Jonathan and I will see you in the next video.
Bye-bye.